It's a big week for the U.S. economy. A new report on inflation was released just a little bit earlier this morning, and the Fed's last decision on interest rates for 2023 is tomorrow. We're joined live by Greg McBride, Chief Financial Analyst for Bankrate. Thank you so much for being here this morning. I think, I talk to so many people, and you get all this data in all the time. To you, what does today's report really show about the state of the economy? Because many people have many different opinions.
Yeah, and what we're seeing here, Jamie, is that inflation's moving in the right direction. It's coming down slowly, but the reason you get such a divergence of opinions and feelings about that is we're not talking about prices coming down. We're just talking about them not going up as fast as they were. So that budgetary pressure that households feel now and have been feeling for the past few years, that continues. That's very real. Prices aren't going up at the breakneck pace that they were before, but by and large, they're not coming down.
So, I mentioned this just a short time ago, the Federal Reserve meeting for the last time today and tomorrow. What are we expecting to see happen? I know there's a lot of opinions about this too.
Yeah, this really validates their stance that they're going to hold interest rates steady, but they're not in a hurry to start cutting those interest rates in 2024. Yes, inflation's moving in the right direction, but the goal is to get to 2%. And right now, inflation's still running 3-4%. So still a ways to go. And what the Fed is going to do is going to keep these interest rates where they are right now for some time to come. There's a lot of expectations that they're going to be aggressive to trim interest rates. There's nothing in the economic data that suggests that that'll be the case.
Which is interesting because, you see home prices and home sales at all time. It's the prices at highs and sales at lows. And so people looking at those interest rates just to see if anybody's going to move. I do want to talk too about savings rates. If you have cash, it seems to be outpacing inflation, but borrowing costs are still high. And we know a lot of people have to borrow money, especially this time of year. What does this mean for consumers in the long run?
Yeah, on the savings side, things continue to look very positive going forward. You mentioned earning more than the rate of inflation. That's going to continue into 2024 as long as you have your savings in the right place. Look for those online savings accounts where you can earn 5% or more. But on the borrowing side, those rates are not going to come down anytime soon, particularly that high-cost credit card debt. So you really have to put the hammer down and do whatever you can to get that debt paid off as quickly as you can. Utilize low-rate balance transfer offers. Some of these cards offer 0% for 21 months. That's a great tailwind in terms of getting out of debt.
To you, is there mixed messaging here? I read an article yesterday, talking about home sales, as I was just saying, where people don't want to give up their 3% interest rate. So you've got a lot of people just kind of stuck on the sidelines when it comes to the real estate market. That can have ripple effects to the rest of the economy. If people are saving their money and just sitting on it, not spending, you have an issue. If you have people who have too much debt, you have an issue. You have a lot of people talking about they feel like they're in a recession, but then you see the job market. All of this just seems so confusing. How are you talking to people about sorting through all of the information that's out there right now?
Yeah, I think a lot of those headline numbers really distort what's happening below the surface. And when you look below the surface, yes, the economy's growing and people are spending money, but let's look below the surface. 60% of U.S. households live paycheck to paycheck. And so, yes, people are working, they have the paychecks coming in, that money's coming in, but it's also getting spent. But the reality of it is, for the vast majority of U.S. households, a lot of that spending, it's out of necessity, not choice. They're paying more, they're spending more, but they're getting the same amount of stuff because of what inflation has done. So that spending, yes, it's been robust, but a lot of times income hasn't kept up with that. Credit card debt has bridged that gap, especially in instances where savings has already been run down.
All right. Thank you for trying to make sense of that, Greg. We appreciate you joining us this morning.
Thanks for having me.